Thank you very much, NTV, for giving us an opportunity to share with the viewers about what is taking place right now in this COVID period. As you know, businesses have closed, and some are just beginning to reopen. But amidst all this, one thing is going on: recording financial transactions in the books of accounts of businesses. And because of that, we felt it's very important that we share this with the viewers this morning. Just take you through what we are going to look at in this presentation. First is the introduction to financial record keeping in the business. Second, who are the users of the business or financial information that we prepare? And then the key items that the financial records must show, and also the need for keeping financial records in the business. And then finally, what do we expect to have at the end of a period, the end of a trading period for a business, the financial statements, the final financial statements. Now, record keeping in business is essentially concerned with how do we record financial transactions? What do we record? Making sure that we do not omit any transaction, because every transaction, for as long as it relates to business, matters. But beyond the financial transaction, there are also other non-financial transactions that must be kept in the records of the business. Things like sales agreements. They are also very important in the record keeping of a business. And when we have recorded this information, we rearrange that information in such a manner that it can be used by the different stakeholders for the different purposes. So different stakeholders have different interests in these financial records. Now, who are these who are interested in the business financial information that we compile? First are the managers of the company. They need to be sure how they are performing. They need to have a record of who their customers are, and so we must keep a record to make sure that when they need this information, they can easily access it. Then very important are the shareholders. At the end of the period, shareholders want to know how they are performing. Are they making a profit or they are making a loss? Then the lenders, people who may give money to our business. They want to see whether you have sufficient cash flows to sustain the business as a whole, whether you are able to repay back and within the times that they may have specified in the lender's agreement. And so they will be interested to see that you have sufficient cash flows which can be sufficient to cover the repayments, and also be able to retain with some money for other operating obligations. Then the tax authorities, they're also interested to see that indeed for the profit you have made, there is a portion that is supposed to be a tax to the government, and so that you pay that tax to government. And then the government, through its other agencies, may also be interested to know how the business is operating, what they are doing, and whether whatever they are doing is legal and legitimate. Then very important are the financial advisors and auditors. They also too want to know whether the way the financial records have been presented are true and fair, so that at the end of the period, we know that what has been captured is a true representation of what has taken place. Now, there are key things that we must know when we are recording financial transactions. First is profit. This is the excess of income over the expenses incurred to make that income. If you have made more income over the expenditure incurred in the period, then you have made a profit. The other key item that we need to know are the assets, the equipment that the business owns. This is very important because it comprises of very key valuable items the business uses to conduct its business, like machinery, plant, land, and furniture. So this is very, 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 very important. Now, the assets that we capture in our records, these are very key, but are classified in two major components. The non-current assets, those that we intend to use in the business for a period longer than 1 year. And then the current assets, those assets we have for use in the period, for a period shorter than one year. Also, our financial records must cover liabilities. Liabilities. These are the claims against the business. It could be a bank loan. It could be a credit supplier, somebody has supplied it and you haven't paid. And anything that the business owes to other parties. Now, just like the assets, the liabilities are also classified into two: the non-current liabilities and the current liabilities. The non-current liabilities being those obligations that you intend to settle in a period exceeding 1 year. And then the current liabilities being those obligations that you intend to settle in a period of less than 1 year. The current liability can constitute things like an overdraft. If you have an overdraft with a bank and you intend to pay it in a period of less than 1 year, that qualifies as a current liability. And then for the non-current liabilities, a bank loan that you are settling in a period exceeding 1 year qualifies as a non-current liability. Now, why do we need these financial records? Why do we need them in the first place? First is that we want to know at the end of a period, how has the business performed? What's the financial performance of the business? But most importantly, we also want to know the changes in the financial position. How has the ownership of the business changed over time? You know, if you have got a new shareholder on board, we want this to be revealed, and so the financial records will be able to show that. And very important is to know the state of cash flows that the entity has, how liquid is the business. But also important to note is to know the trade associates. Who are these people you are corresponding with in business? To just be sure that indeed the business is doing legitimate business. Also, we record these financial transactions to make sure that we keep track of all the transactions, so that we do not fail to pay people whom who have supplied us on credit, and we need to repay them when the obligations arise. And also, there are people we may sell to on credit. We also want to make sure they pay us, and we can only be able to follow up if we have a record of these debtors. Then it is also important that we capture a record of the key records of our documents, things like sales agreements that you have entered into with suppliers, so that should there be need for reference to these at a later date, we can easily refer to these kinds of agreements. Now, we said that we keep these records, financial records, among other things, to find out the financial performance. Now, one of the key statements in our accounts that can show us the financial performance is the statement of comprehensive income. It shows us the revenue that the entity has generated in the period. It also shows us the expenses that have been incurred to make that income possible. And if the income exceeds the expenses, then we have a profit. If the expenses exceed the income, then we have a loss. Now, this statement of comprehensive income is prepared usually for 1 year. But also, it can be prepared for shorter periods, just in case there is a special need for that. We also said one of the reasons we prepared the financial records is to know the financial position of the entity. Now, for us to be able to know the financial position of the entity, we prepare what we call the statement of financial position or the balance sheet. And this shows us all the assets and liabilities that the entity has. And it also includes the capital that the owners of the business have contributed. And essentially, in this balance sheet, the total assets that the entity has will equal to the capital that the owners of the business have contributed and the liabilities that have been incurred by the business in that period. Now, we have capital and revenue expenditure. These are very key items that we must capture when we are recording financial transactions. Capital expenditure is expenditure incurred to acquire non-current assets. And so when we incur a capital expenditure, at the end of the transaction, we recognize an asset in the balance sheet. Also, we have what we call the revenue expenditure. Revenue expenditure is expenditure incurred in the ordinary conduct of business. The purchase of stock, trading stock, is a typical revenue expenditure item. Purchases of payments for wages and salaries, rent, and other operating expenses, those are revenue expenditure items. Now, the key distinction between these two terms, capital expenditure and revenue expenditure, is that whereas revenue expenditure appears in our income statement, being charged against the income of that period to come up with a profit, capital expenditure is never recorded in our income statement. Instead, like I said earlier, when we incur capital expenditure, that expenditure is captured in our balance sheet as an asset. We also have capital and revenue expenditure. And we said capital expenditure is expenditure incurred to acquire non-current assets. And once we incur a non-current, once we incur a capital expenditure, we do not include that expenditure in the income statement. Instead, it results into an acquisition of an asset which appears in the balance sheet. Of interest to note that when we incur a capital expenditure and we acquire a non-current asset, that non-current asset is subject to depreciation, and that depreciation is charged in our income statement for the period of operation. As already said, capital expenditure enables capital expenditure, which is expenditure on acquiring non-current assets, results into the appearance of a non-current asset in the balance sheet. Now, revenue expenditure on the other side is expenditure incurred to acquire trading stock, goods and services that the business deals in. It is also expenditure on wages and salaries. It is also expenditure on rent and all the other operating expenses. But also very important, if you spend some money in order to maintain the earning capacity of your asset, to make sure that your asset is well maintained, that expenditure is also revenue expenditure, and so is included in your income statement. Note, we are only talking about expenditure incurred to maintain the asset. If you have a building and you paint it, the painting is revenue expenditure. But the cost of setting up the building is a capital expenditure, but the cost of painting just to maintain that asset is a revenue expenditure. And so the revenue expenditure part, which is the asset, the cost of painting, can appear in our income statement. Now, revenue expenditure for a given period is matched against the income of that period so as to arrive at the profit in that period. In other words, how much have you sold vis-a-vis how much have you spent in terms of buying stock, in terms of paying for operating expenses. The difference between that revenue expenditure and the income in the period gives us the profit in that period or loss. Viewers, let's go for a commercial break, and then we shall continue from here when we come back. Capital and revenue expenditure. Capital expenditure is expenditure incurred to acquire non-current assets. And so when we incur a capital expenditure, we recognize an asset in the balance sheet. On the other hand, revenue expenditure is expenditure incurred on the routine trading activities of the business. These can include the purchase of trading stock, payment for wages and salaries, operating expenses such as rent, utilities. All these are revenue expenditure. Now, capital expenditure is not charged in the income statement. It's not charged in the income statement. Instead, whenever we incur capital expenditure, we recognize an asset in the balance sheet. On the other hand, when we incur revenue expenditure, that expenditure is charged against the income in the income statement to arrive at a profit or a loss in the period. Now, when we acquire a non-current asset, when we have incurred capital expenditure to acquire that non-current asset is subject to depreciation. Now, that depreciation is also charged as an expense in the income statement alongside the other items of expenditure. In contrast, the capital expenditure, once we have acquired that asset, it will simply be taken to our balance sheet as an asset we have acquired. Now, the revenue expenditure is taken to the income statement, and it is charged against the income that has been made during that period to arrive at a profit if we have made a profit, or a loss if we have made a loss. Now, let's look at capital income and revenue income. Capital income is income from the proceeds of sale of a non-current asset. Now, because this is income from the sale of non-current assets, it's not put in our income statement. No, it's not. However, revenue income, which is the income from the ordinary trading activities of the business, is included in our income statement. However, it can happen that in the sale of a non-current asset, you make some profit on that asset. If you have an asset which has been written down, say, to 10 million, and then you sell that asset at 12 million, the 2 million you have made on that non-current asset, when you sell, what we call a gain on disposal, is included in the income statement as one of the gains for the period. and so is a loss. You may also sell a non-current asset in the period, and you sell it at less than the written down value of that asset. If it was said it had been written down to 10 million and you sell it at 8 million, that loss you have made on the sale of that non-current asset is put in our income statement as an expense for that period when the sale has taken place. So this is very important to distinguish between the two, capital income and revenue income. And for our small and medium enterprise business owners out there, there is always this mistake to include what you have sold as a non-current asset as part of the income in the income statement. This should not be the case, as we have already explained. Now, what comprises revenue income? A number of aspects comprise revenue income. The stock that you sell, whatever you are dealing in, when you sell, that's part of revenue income. But also you may be a company, but you have invested somewhere also, or you have put your money in a fixed deposit account in the bank, and so you earn some interest. That interest is also part of revenue income, which you need to put in your income statement. Or you may get some, you're a business and you have invested somewhere and have given you dividends for the business. Those dividends are also part of revenue income. And for revenue income, like we're saying, this is income from the ordinary trading activities of the business. And depending on what you are dealing in, what you sell in the ordinary conduct of business constitutes your revenue income. But if you're a business which has also made some investments somewhere and you get dividends, those dividends are part of your revenue income for as long as that investment is held by the business in some other company. Also, you may earn some interest as a business because you have deposited some money, say, on a fixed deposit account and they give you some interest. That interest also constitutes revenue for your business. Now, for service companies, when you charge a fee for the services you offer, that is also revenue for the business for that period in which that service has been offered. So let's have a break, viewers. We shall continue from there when we come back from the break. Viewers, welcome back from the break. Let's take it on from where we stopped. Before, we were talking about revenue income, and we said this was income obtained from the ordinary trading activities of the business. And also said there is capital income, being income that you get from the sale of non-current assets. And we said that revenue income appears in our income statement as the income against which we charge expenses we have incurred in that period. But we also said capital income, which is the income from the sale of non-current assets, does not appear in the income statement. Instead, when we make a sale of a non-current asset leading to capital income, that income is not part of the ordinary income of the business, and so does not appear in the income statement, except to the extent that we may have a gain on that asset we have sold. And if the asset had a written down value of, say, 10 million, and we sell it at 12 million, then that profit we have made on the sale of that non-current asset is put in our income statement as a gain. Also, we may make a loss on selling a non-current asset. Again, it's only the component of the loss that we put in the income statement. For example, if you had an asset that had a written down value of say 10 million and you sold it at 8 million, then you have made a loss on that non-current asset. And so the 2 million loss you have made on it is what we include in our income statement as a loss or as an expense in that period. Now, let's go to the next part of our presentation, and that is about trade accounts payable or creditors and the trade accounts receivable. In the conduct of business, you may get some suppliers who may sell to you goods on credit, and so you don't pay there and then. Now, when that happens, you now have what we call trade accounts payable, the creditors of the business arising from the credit purchases. But also, you may too also sell to your customers on credit. And so, if at the end of the period they have not yet paid you, you now have credit, debtors, people you have sold to on credit, and they haven't paid you yet at the end of the period. And so in our records, we need to always capture these two. Who are those we owe money to? We bought on credit and we haven't paid them. Those are creditors. And those we sold to in the course of the business and they haven't paid to us, whom we call the debtors or trade accounts receivable. Now, in summary, this is very important, viewers. At the end of a trading period, the business should have the following financial statements. First is the income statement, or the statement of comprehensive income. And this, like we said at the beginning, it simply shows us how much revenue have we made, how much expenses have we incurred in making that revenue. And so it shows us a profit if I've made a profit, or a loss if I've made a loss. Then also we have a statement of financial position. This shows us a record of the assets and liabilities at the end of a period, and also the capital contributed by the owners of the business. The other statement that we must have at the end of our accounting period is the statement of cash flows, which essentially shows us how the business has generated cash flows in the course of the business, in the course of the operations. Has it made its cash more from the ordinary trading activities, what we call the operating activities, or how have the cash flows been in the area of investments? Has the business undertaken some investments, and so there have been cash flow movements in that area? Or have we gotten some financing by way of credit facility extension by financial institutions, in which case we are able to show that the cash flows have come through the financing section of our cash flow statement. And then lastly, the statement of changes in equity. How has the ownership of the business changed over time? Have you had any retained earnings that have been redistributed, for example? Or have you made profit in the period, which now constitutes part of our equity in the current period going forward? All these are shown in our statement of changes in equity. Now, beyond these financial statements, there are also non-financial statements, things to do with notes to the accounts. They provide information to the owners of the business, to the stakeholders, providing additional information that the financial statements may not reveal. For example, now we are in this COVID period. Businesses have not performed well, and they are unlikely to perform well by the end of the period. Now, the issue which will arise is, how do these financial statements compare with those of, say, 2019? So a note to these accounts saying in the period under review, or the period 2020, we had business closures because of compliance with guidelines issued by the Ministry of Health, and so it affected the business performance, is very important. and indeed it will help the users of these financial statements to understand better why the performance is far less than or not comparable at all to the previous period. And so that is very important information and helps the users to understand the accounts much better and to derive much more understanding of what has taken place in the period. So with that, viewers, thank you for listening and keep safe.